I'll start with the market for lithium, and then we'll kind of dive into
Yeah.
operating costs. The market to lithium over the last 20 years has been fascinating. So from 2010 to 2018, we saw a 3x in lithium demand. And that's not unexpected. And that 2010 to 2018 was kind of the decade of the EV. We saw Tesla and Chevy and Ford and everybody introduce really commercial, attractive electric vehicles. No one wanted to drive a Prius. Everyone wants to drive a Tesla. And we saw that become kind of vogue. And it's not surprising that lithium demand 3x'd in that time period. What is really surprising is the projections that big investment banks, big reputable investment banks, are giving on the demand for lithium from 2018 to 2028, where they say it's going to 10x. And I think that is largely driven by not only EVs, but battery storage projects. And these battery storage projects are a big high demand on lithium. So if you take that as your fundamental premise that the market demand is going to be there, well, you know there's going to be an increase in the cost of lithium as a raw material. So I have and I'll pull it up so I don't misquote it. I have a chart that was kind of the cost of lithium. Reuters did this article back in 2019 called Game of Mines. And this was before we really started looking at lithium extraction through a DLE lens. And the lithium cost per ton got all the way up to 24,000 per metric ton. And when I say metric ton, I mean TONNE, which for anybody in the United States, who cares? The difference between like a ton TON and a TONNE ton is like 36 pounds, so whatever. But that's what everybody measures. So everybody measures lithium in. And so it was at $24,000 in 2019. Last year, lithium was trading at $36,000 per TONNE ton. Wow. And I think that you'll probably see there's some projections that show that number going between 40 and 50 in the next few years. So if you're thinking of the numbers as being driven by demand, and that demand is driving stuff up to $40,000 per ton of lithium, then okay, what are our operating costs? Your operating costs are actually really low on evaporation. They're less than a DLE plant. So in their last 10K, I believe Standard Lithium put their operating costs on a DLE plant at about $4,000 per ton. Oh, wow. And the cost of evaporation, I have read, can be as low as like $1,200 per ton. But here's the deal: is it costs you $1,200 per ton, and it takes you 18 months to get that ton. This costs you $4,000 per ton, and it takes
10 hours.
Yep, exactly. Yeah. And so that economy of scale is certainly present there. You are able to scale up much quicker on production. And as a result, you're willing to take a hickey on what it costs to produce. And remember, we can't do evaporation everywhere. There are very few.
You have to be in arid climates, right?
Yeah. You just can't do it everywhere. And outside of, the valley in Nevada, we just don't have those commercial facilities in the United States. And I am a firm believer that we won't, and the DLE will drive the industry. So when you're selling lithium at $40,000 and your costs to get it to market are 10% of that, pretty good margin. That's something that is really attractive.
Yeah. And so what's the expectancy of like a well? Like, how many tons do you think you could get from a well? Is there any metrics on that?
No one has released any good metrics so far. And that's because from a lithium standpoint, no one's really had big commercial wells. I mean, they've re-entered well bores to figure out tests, and everybody's still in the land grab phase. I think we'll know more of that probably in the next 12 months. And I think they'll release that information even
later,
longer than that. They have an obligation to their shareholders, the publicly traded companies, to eventually release it. But it's this fine line between what do I want to tell my competitors and what do I want to make my stock price do. It's a fun dance that I'm glad I don't have to do.
Yeah. So on the commercial terms, so we talked about operating costs. How are the are these leases structured? What are we seeing on that front? What's to the mineral owner or the landowner? How is that compensation factored in?
Yeah. Yeah. Good question. And it actually differs between the state of Arkansas and the state of Texas. So because the state of Arkansas, it has oil and gas present, right? We all have seen the SMAC overproduced. We all watched the Fayetteville shale play for a little bit. Chesapeake was a mover and shaker in Arkansas for a bit. They aren't a nascent mineral industry, but they're nowhere near what we are in Texas. And when people started putting lease forms together in Arkansas, it was really just a rental approach. And granted, when they settled legislation that said the mineral owner owned it by defining saltwater as a mineral, the competition between surface and the mineral estate went away. And so it was kind of like, we know you, there's no risk, we're going to pay you what's market. And they did a rental approach. And, you saw rentals as low as $2.50 per acre per year. And then you started seeing rentals that were a little higher. There were some folks that were paying per barrel of brine. And we're talking in like the single digit cents per barrel of brine kind of numbers. Then when it moved down to Texas and we started seeing the land grab in Texas, mineral owners were like, shoot, to create a complete alignment, we want royalty, y'all. We don't want just this rental. What do you think you are, a deer hunter? We're not going to pay you. You can't pay me just a price per acre to use my land. And so they negotiated this form of royalty that's much lower than what we would see in the oil and gas world. I mean, that you're seeing single digit royalties, not 25%. Yeah. And I think that'll be driven up over the next couple of years as the commercial viability is proven out. But until then, you're going to get this weird hybrid of a price per acre and a royalty. And so what it's really turned into is this price per acre during an option period that gives everybody the right to go out and test water. And then once the viability of it's the equivalent of running seismic on an oil and gas property. Once the viability is proven, they enter the primary term and they have a certain number of years to drill a well or pool it with lands that a well is drilled with. And typically they're still paying a rental during the primary term. But as soon as a well is drilled, it's a combination of a rental and a royalty.
Yeah, makes sense.
That royalty is so low that it sort of is de minimis in the grand scheme of things right now. But I think eventually you'll start seeing those royalties increase.